On January 14th, 2026, at 3:47 p.m. Eastern Time, the dollar index broke through 98.3 and stayed there. Not headline news, not a crash, just a number on a screen that most people ignored. But if you understand how currency desks operate, you know what that means. Let me explain what the dollar index actually is. Think of it as a scoreboard that measures the dollar's strength against 6 other major currencies, like the euro, the Japanese yen, and the British pound. When this number goes up, the dollar is getting stronger. When it goes down, the dollar is getting weaker. The 98.3 level is important because it's like a floor that the dollar kept bouncing off of. That level hasn't held as resistance since April of last year. And when institutional positioning is already leaning one direction, meaning the big money managers are already betting the dollar will fall, and then a technical level that's been tested 4 times finally gives way, the people managing billions in FX exposure start making calls. FX means foreign exchange, the market where currencies are bought and sold. What almost nobody is talking about is the accumulation pattern that's been building since November, not in headlines, in flow data. Think of flow data like watching where water is moving in a river. We're not looking at the surface, we're looking at the current underneath. In basis swaps, these are specialized contracts that tell us how much stress there is in currency markets. In the composition of who's actually bidding at Treasury auctions, when the US government needs to borrow money, they sell Treasury bonds at auctions, and we can see exactly who's buying them and who's not showing up anymore. The public story is that the dollar had a rough year in 2025, down about 10%, but now it's stabilizing. The real story is that someone with enough capital to move markets has been methodically building a position that only makes sense if they believe the dollar is going lower, much lower. And when I say someone, I'm talking about George Soros. I'm going to show you exactly why this trade is being structured the way it is, what the underlying mechanics tell us about where this is headed, and why the assumption that has kept the dollar stable for the last 30 years can't hold anymore. By the end, you'll understand why this isn't speculation. It's arithmetic. I spend my time monitoring capital flows, cross-border positioning, and the gap between what central banks say and what their balance sheets actually do. Capital flows are like tracking which direction money is moving around the world. Is it flowing into the United States or out of it? Cross-border positioning is about understanding where the big institutions, banks, and funds have placed their bets. When I see certain patterns, I don't need confirmation from press releases. The data speaks first, markets speak second. Officials speak last. Let me explain one term that's critical to understanding this. Basis swap spreads. I know this sounds complicated, but think of it like this. Imagine you're a European bank and you need dollars for 3 months to do business in the United States. You have 2 options. Option 1, you can go directly to the dollar lending market and borrow dollars. Option 2, you can borrow euros, which you have easy access to, and then swap those euros for dollars through what's called a cross-currency basis swap. It's like a temporary currency exchange with another bank. The difference between what these 2 options cost you is called the basis. Here's the simple version. When that difference gets bigger, it means there's stress in the system. It means people desperately need dollars right now and they're willing to pay extra to get them. It's like when there's a shortage of concert tickets and people will pay above face value just to get in. That urgency creates a premium. But when that spread compresses and then inverts, meaning it becomes cheaper to get dollars through the swap than to borrow them directly, it tells you something else entirely. It tells you that the people who normally scramble for dollars have stopped scrambling, that they're hedging the other way, that they're preparing for dollars to be worth less, not more. It's like when everyone is selling concert tickets below face value because they think the show is going to be terrible. That's where we are now. The official story is straightforward. The dollar fell in 2025 because of policy uncertainty, some tariff noise, concerns about fiscal deficits, and a rotation out of U.S. assets as other regions started to look more attractive. You'll hear people say the dollar is in a normal correction after a strong run, that it's healthy, that diversification is natural. That's not what actually happened. What happened is that the largest macro funds in the world, the ones that move size, started testing whether the dollar could actually defend the levels it was trading at. They tested it in April with Liberation Day tariffs. The dollar spiked briefly, then collapsed. They tested it again in July when employment data came in weak. The dollar couldn't rally. They tested it in September when geopolitical risk should have sent money flooding into treasuries. It didn't. Each time, the bid was thinner than it should have been. By November, the pattern was clear. The dollar wasn't correcting. It was being systematically drained. Here's how the system is supposed to work. The dollar is the reserve currency of the world. What does that mean in plain English? It means that when countries need to save money for emergencies or for future investments, they save it in dollars. It's like how you might keep your savings in a bank account. Countries keep their savings in dollars. That means central banks hold it. Corporations need it for trade. If a company in Japan wants to buy oil from Saudi Arabia, they usually need to use dollars to make that purchase. Commodity markets price in it, debt markets denominate in it. When there's a crisis anywhere in the world, money flows into dollars because they're the safest, most liquid asset available. Liquid means you can buy or sell them easily without losing value. Think of it like this. If there's a fire in a building, everyone runs to the same exit they know is safe. In global finance, that safe exit has always been the US dollar. This creates a self-reinforcing loop. The dollar stays strong because everyone believes it will stay strong. It's like a reputation that feeds itself. Now, layer 2. Foreign holders own roughly $9 trillion in U.S. Treasury securities. Treasury securities are essentially IOUs from the U.S. government. When the government needs to borrow money, they issue these securities and investors buy them. That $9 trillion represents 32% of all marketable treasuries outstanding. To put that in perspective, almost 1/3 of America's debt is owned by foreigners. Japan alone holds over $1 trillion. China used to hold more, but has been slowly reducing. The entire edifice of dollar dominance rests on the willingness of these foreign holders to keep rolling over their positions. What does rolling over mean? Imagine you lend your friend $100 for a month. At the end of the month, instead of asking for the money back, you say, keep it for another month. That's rolling over. Foreign countries have been doing this with U.S. debt for decades. They keep lending us money, and when the loan comes due, they just lend us more. The system depends on them continuing to do this. Layer 3. The U.S. runs a structural current account deficit. Let me break that down. The current account is like a national income statement. It measures all the money coming in from exports and investments versus all the money going out for imports and investment payments abroad. We import more than we export. We buy more foreign goods than foreigners buy from us. That means we need foreign capital inflows to balance the ledger. Think of it like a household that spends more than it earns. To keep functioning, that household needs to borrow money or sell assets. The U.S. is the same way. We need foreigners to want to hold dollar-denominated assets. We need them to keep buying our treasury bonds. If they stop wanting to hold those assets, we have to offer them higher yields, higher interest rates to make it worth their while. Higher yields mean higher borrowing costs. Higher borrowing costs mean the government has to spend more money just to service the debt, which creates fiscal stress. Layer 4. The dollar's share of global foreign exchange reserves has been declining slowly since 2001, when it was 72%. Now it's 56%. Let me put this in context. Foreign exchange reserves are the savings accounts that countries keep. For 2 decades, the dollar's share of those savings accounts has been shrinking. Still dominant, yes, but the trajectory is clear. Central banks are diversifying. They're buying euros, yen, gold, even Chinese renminbi. It's like if you used to keep all your savings in one bank, but now you're spreading it across several banks just to be safe. Each marginal shift away from the dollar reduces the pool of structural buyers, the institutions that automatically buy dollars no matter what. Layer 5. The U.S. fiscal position is no longer what it was. The debt to GDP ratio is elevated. This ratio compares how much debt the government owes to the size of the entire economy. It's like comparing your personal debt to your annual income. If you make $50,000 a year and you owe $100,000, that's a debt-to-income ratio of 2 to 1. The U.S. government's ratio has been climbing. Deficits are structural, not cyclical. Cyclical means they go up during recessions and down during booms. Structural means they're built into the system permanently. We're not running deficits because of a temporary economic downturn. We're running them because spending consistently exceeds revenue, and there's no political will to change that. That means more treasury issuance, more supply hitting the market, more bonds being sold, and all of that supply needs buyers. We're more reliant than ever on foreign demand to absorb it, and foreign demand has been flat for a decade. Each of these layers increases dependency on the next, and each layer assumes that the one before it will hold. It's like a Jenga tower. Each block depends on the stability of the blocks below it. Here's the assumption that broke. It's simple, and it's been true for 30 years. The assumption is this: when stress appears anywhere in the system, the dollar rallies. Flight to safety, flight to liquidity. The dollar is the safe asset. That's the anchor. But in 2025, that stopped working. Geopolitical stress in the Middle East in October. The dollar went nowhere. Banking stress in Europe in June. The dollar rallied for 2 days, then gave it all back. Trade war escalation in April. The dollar spiked, then collapsed. Each time the reflex trade worked for a few hours, maybe a few days. Then it failed. That's the break. The one thing the system depends on, the one behavioral pattern that has to hold for dollar dominance to remain intact, has started to fail. And once it starts to fail, it creates a different kind of loop, a negative one. Let me walk you through the internal calculation that someone like Soros is making. This is the math that drives the trade. Start with a baseline assumption. Foreign central banks hold $7 trillion in dollar reserves. Over the last 2 years, they've added almost nothing to that. Zero net growth. It's like if you had a savings account that's been stuck at the same balance for 2 years, you're not adding to it anymore. Now add a new condition. the dollar loses 10% in 2025. That's already happened. If you're a reserve manager sitting in Tokyo or Beijing or Riyadh, and you just watched your dollar holdings lose 10% in purchasing power terms against the euro, against the yen, against your domestic currency, what do? Let me make this concrete. Imagine you're the person in charge of Japan's savings. You hold $1 trillion in US Treasury bonds. Last year, the dollar fell 10% against the yen. That means your $1 trillion is now only worth about $900 billion in terms of what it can buy in Japan. You just lost $100 billion in value. Not because the bonds went bad, but because the currency they're denominated in got weaker. What's your response? You don't panic, you don't sell everything, but you stop buying new issuance. You let old positions mature and you don't roll them over. You wait. You want to see if this is temporary or if it's a trend. Now here's where it gets critical. The US Treasury needs to issue another $2 trillion in new debt this year to fund the deficit. That's $2 trillion in bonds that need to be sold. Who's going to buy it? Domestic buyers can absorb some. American pension funds, banks, individual investors, they'll buy some. The Fed isn't buying anymore. They stopped their quantitative easing program. Foreign private investors might step in if the yield is attractive enough. If you offer them a high enough interest rate, they'll consider it. But if foreign official buyers, the central banks, the ones who have always been the structural bid, the reliable buyers who show up at every auction, if they step back even slightly, yields have to rise to clear the market. Think of it like a house auction. If your regular bidders don't show up, you have to lower the starting price to attract new bidders. In the bond market, lowering the price means raising the yield. They're inverse. When bond prices fall, yields rise. Higher yields mean higher debt service costs. The U.S. is already paying over $1 trillion a year in interest on the national debt. That's more than we spend on defense. If yields rise another 50 basis points across the curve, that's half a percentage point. That's another $100 billion in annual costs within a few years. And it compounds. That's another $100 billion that has to be financed, which means more issuance, which means more bonds to sell, which means more pressure on yields to rise even higher. This is where the math breaks. The catastrophic outcome isn't a default. The U.S. government isn't going to declare bankruptcy. That's not how this ends. It's a forced devaluation. The dollar has to fall enough to rebalance the external accounts. It has to fall enough to make U.S. exports competitive again. Think about it. If the dollar gets weaker, American products become cheaper for foreigners to buy. That boosts exports. It has to fall enough to reduce the real value of the debt burden. If you owe $1 trillion and the dollar loses value, you effectively owe less in real terms. And if the market senses that this is the path of least resistance, that this is the implicit policy choice being made, that the government would rather let the dollar fall than cut spending or raise taxes dramatically, then positioning accelerates in that direction. Traders start betting on it. That's the trade Soros is making. He's not betting the dollar collapses tomorrow. He's betting the only way out of the fiscal trap is a weaker dollar, and he's positioning for that outcome before the market fully prices it in, before the crowd realizes what's happening. When a currency starts to lose the confidence of marginal holders, the feedback loops are nonlinear. Nonlinear means they don't move in a straight line. They accelerate. Think of it like a bar that's too crowded. Everyone's fine, having a good time until someone yells fire. Then everyone moves to the exits at once. The exits are narrow. Not everyone gets out. There's a stampede. That's what nonlinear means in this context. In currency markets, the exit is liquidity. Liquidity means the ability to buy or sell something quickly without affecting its price too much. When you want to sell dollars, you need a buyer on the other side. When everyone wants to sell dollars at the same time, the bid-ask spread blows out. Let me explain what that means. The bid is what someone is willing to pay for your dollars. The ask is what you're willing to sell them for. Normally, these numbers are very close. You might be willing to sell at 1.10 euros per dollar, and someone's willing to buy at 1.9 euros per dollar. The difference, 1 cent, is the spread. When markets are calm, spreads are tight. But when panic sets in, that spread widens dramatically. Buyers step back and say, I'll only pay 1.0 euros per dollar. But you want to sell at 1.10. The spread just went from 1 cent to 10 cents. Market makers, the banks and firms that usually facilitate these trades, step back. They don't want to be holding dollars when prices are falling, so they stop providing liquidity. Depth evaporates. Depth means how many buyers are waiting at each price level. In calm markets, there are buyers every few cents. In panicked markets, there might be no buyers for 50 cents or more. What looks like a 10% move on a chart can feel like a 20% move in execution because you can't get the price you see on the screen. You see the dollar index at 95, but when you try to actually sell your dollars, you can only get a price equivalent to 93. That's slippage. That's what happens when liquidity disappears. Here's the loop. Foreign holders see the dollar weakening. They hedge a small portion of their exposure, just in case. Hedging means protecting yourself against losses. It's like buying insurance. That hedging shows up as dollar selling in the forward markets. Forward markets are where you agree to exchange currency at a future date. Dealers who are short forwards, who have promised to deliver dollars they don't have to hedge themselves in the spot market. The spot market is the market for immediate delivery. That's more dollar selling. Spot prices weaken. Now the mark-to-market losses on those foreign holders' unhedged positions get larger. Mark-to-market means valuing your holdings at current prices. If you own $1 million and the dollar falls, your position is now worth less. Those losses show up on your balance sheet immediately. Treasury officials start getting questions from their bosses. Finance ministers start getting concerned. Parliamentary committees want explanations. The pressure to hedge more increases. More hedging means more selling. The loop accelerates. At the same time, importers who need to buy dollars for trade start pulling forward their purchases. An importer is a company that buys goods from abroad. If you're a European company and you need dollars to buy American products, and you see the dollar has been falling, you might think, it's cheaper now, I should buy the dollars I'll need for next month's purchases today. That creates short-term dollar strength, which looks like a rally on the charts, but it's just time-shifting demand. You're not creating new demand, you're just moving future demand into the present. Once that wave passes, once all the importers who were going to buy dollars in the next 3 months have already bought them, the selling pressure resumes. And it resumes at a higher level because more participants are now aware of the trend. The cat's out of the bag. This is why the move, when it comes, won't be smooth. It'll be stepwise. A few weeks of stability, then a sharp drop. Another few weeks of consolidation, prices moving sideways, then another drop. Each drop shakes out another cohort of holders who thought they could wait it out. First, the weak hands sell, then the medium strength hands. Eventually, even the strong hands start to question whether they should hold on. Right now, we're living in two realities. There's the price reality and the flow reality. The dollar index is trading at 98.3. That's the price you see on your screen. But the flow reality is that nobody wants to add to dollar exposure. Central banks aren't buying. Sovereign wealth funds, those are the investment arms of countries that have extra money, aren't buying. Corporate treasurers are hedging, not accumulating. They're protecting what they have, not adding more. Think of it like a stock that's trading at $50 per share. The price says $50, but when you look deeper, you see that all the smart money is selling. Insiders are selling, institutional investors are selling. The only people buying are retail investors who don't know any better. The price might say $50, but the flow tells you it's going to $30. That's the divergence. There's the paper reality and the physical reality. On paper, the US economy looks resilient. GDP growth is positive. The economy is growing. Unemployment is manageable. People have jobs. The headlines are generally good. But the physical reality is that the US is running out of policy space. Policy space means options. Interest rates can't go much higher without breaking something. If the Fed raises rates too much, mortgages become unaffordable, businesses can't borrow to invest, the housing market crashes, stock prices fall, something breaks. Fiscal policy is locked in, the government is politically gridlocked. There's no consensus on cutting, spending, or raising taxes. The only release valve is the currency. The only way to relieve the pressure is to let the dollar fall. There's the narrative reality and the mechanical reality. The narrative is what you hear on CNBC, what you read in the Wall Street Journal. The narrative is that the dollar's weakness is temporary, that it'll stabilize, that U.S. assets are still attractive. Everyone's still talking about American exceptionalism, about how the U.S. economy is the strongest in the world. The mechanical reality is that the Treasury has to issue more debt than the market wants to buy at current yields. The math doesn't care about the narrative. The mechanical reality is that auctions are getting weaker, that foreign participation is declining, that yields have to rise to attract buyers. The mechanics of supply and demand don't lie. These realities can diverge for a while, months even. Markets can stay irrational longer than you might think. People can believe the narrative while ignoring the mechanics, but they can't diverge forever. Eventually, price has to reflect flow. Reality has to catch up. Paper has to reflect physical. Narrative has to reflect mechanics. When those gaps close, they close violently. It's like a rubber band that's been stretched too far. It doesn't snap back gradually, it snaps back instantly. Let's talk about the three possible outcomes here. Think of these as three different roads this situation could take. First, the impossible scenario. The dollar stabilizes on its own. Foreign demand for treasuries picks back up. Countries that stopped buying start buying again. The U.S. fiscal path improves. Maybe Congress actually agrees on spending cuts or tax increases. Growth accelerates enough to outrun the deficit. The economy grows so fast that the debt becomes less of a problem relative to the size of the economy. In this scenario, the dollar rallies back above 105 and the whole concern fades. Everyone breathes a sigh of relief and says, see, it was nothing. Probability, less than 10%. Here's why. The structural drivers haven't changed. The incentives haven't changed. This would require a fundamental shift in global capital allocation that I don't see coming. It would require politicians in Washington to suddenly agree on fiscal discipline when they haven't been able to do that for 2 decades. It would require foreign central banks to reverse course and start accumulating dollars again, despite just watching them lose 10% of their value. Possible? Technically, yes. Likely? No. Second, the chaotic scenario. The dollar breaks below 95 in a disorderly way. This is the crisis scenario. Foreign holders rush for the exits. Everyone tries to sell at once. Treasury auctions start to fail. An auction fails when there aren't enough buyers to absorb all the bonds the Treasury is trying to sell. Imagine you're trying to sell your house, but nobody shows up to the open house. That's a failed auction. Yields spike. If the 10-year Treasury yield is at 4% today, in this scenario it might jump to 5.5% or 6% in a matter of weeks. The Fed is forced to intervene, either by restarting QE, quantitative easing, where the central bank buys bonds to push prices up and yields down, or by coordinating swap lines with other central banks to provide dollar liquidity. Swap lines are emergency arrangements where central banks lend each other currency. Markets seize up. When I say seize up, I mean they stop functioning normally. Spreads blow out, trading halts, people can't get prices, volatility explodes, the VIX, the fear index might hit 50 or 60. Eventually, some kind of policy response stabilizes things, but not before significant damage. Think of it like 2008, but in the currency markets instead of the housing market. Probability? 25%. This is the tail risk. Tail risk means a low probability but high impact event. It's possible if the move accelerates faster than policymakers can respond. If the selling becomes a stampede before the Fed can step in. If coordination between central banks breaks down. It's the nightmare scenario, but it's not the most likely one. Third, the managed scenario. The dollar grinds lower in a controlled fashion. It moves from 98 to 95 over 6 months, then from 95 to 92 over the next 6 months. It's not a crash, it's a slow bleed. Each move is punctuated by verbal intervention. Treasury officials giving speeches about monitoring the situation, saying they're comfortable with a strong dollar. Coordinated statements from G7 finance ministers, all saying they're watching currency markets closely. The Fed emphasizes that they're monitoring the situation, that they have tools available if needed. Treasury yields rise, but not explosively. They might go from 4% to 4.5% over 6 months, then to 5% over the next 6 months. Uncomfortable, but not catastrophic. Inflation picks up as import prices increase. When the dollar falls, everything we import becomes more expensive. Your iPhone costs more, your coffee costs more, gas costs more. But it doesn't happen all at once. It's gradual enough that the system can absorb it. The Fed might raise rates slightly to keep inflation from getting out of control, but not enough to cause a recession. The adjustment happens slowly enough that businesses can adapt, that households can adjust, that foreign holders can reduce their positions without causing panic. Probability, 65%. This is the base case. This is the path of least resistance. Why? Because it's in everyone's interest to manage the decline. The US government doesn't want a crisis. Foreign central banks don't want to take massive losses on their dollar holdings. The Fed doesn't want a repeat of 2008. Everyone has an incentive to coordinate and manage this down slowly. And this is exactly what Soros is positioning for. Not a crash, a managed devaluation. The trade isn't about timing a panic. It's about being positioned before the slow grind becomes obvious to everyone. Here's what this means for you. Do not panic. This is not a crisis in the traditional sense. It's a repricing, a recalibration. The dollar isn't going to zero. The US isn't defaulting. The country isn't going bankrupt. But the era of the strong dollar, the era where US assets were the default choice for global capital, that era is ending. If you hold dollar-denominated assets, which most Americans do, understand that the real value of those assets is declining. Not because the assets themselves are worthless, but because the currency they're denominated in is being devalued. Let me make this concrete. Say you have $100,000 in savings. The number on your bank statement still says $100,000. But if the dollar falls 15% over the next 2 years, what you can buy with that $100,000 has effectively decreased. If you travel to Europe, your dollars buy fewer euros. If you buy imported goods, electronics, clothes, food, they cost more. Your purchasing power has declined even though the number in your account hasn't changed. This is a wealth transfer. It's a transfer from dollar holders to dollar debtors. If you have dollar savings, you're losing purchasing power. If you have dollar debts, especially fixed rate debts like a 30-year mortgage, you're benefiting. Why? Because you borrowed money when dollars were strong, and you're paying it back with dollars that are worth less. It's like if you borrowed $100,000 to buy a house, and by the time you pay it back, those dollars have less buying power. You're paying back the loan with cheaper money. Think strategically. This isn't about timing the market day to day. You're not trying to predict exactly when the dollar will hit 95 or 92. It's about understanding the direction of the larger trend and positioning accordingly over months and years. If you have the option to hold assets in other currencies, consider it. Maybe you have some savings in euros or Swiss francs or yen. Maybe you invest in international bonds denominated in foreign currencies. You're diversifying your currency risk. It's like not putting all your eggs in one basket. If you have exposure to international equities, stocks and foreign companies, that exposure is going to benefit from a weaker dollar. Why? When you own shares in a European company and the euro strengthens against the dollar, the value of those shares in dollar terms goes up. Even if the company's stock price stays flat in euros, you benefit from the currency move. If you're thinking about large purchases, especially imported goods, commodities priced in dollars are going to get more expensive in dollar terms. This is the inflation everyone's worried about. If you're planning to buy a car and half the parts are imported, that car is going to cost more next year than it does today. If you're renovating your house and the materials are imported, those materials will cost more. This is the practical impact of a weakening dollar on everyday life. The key insight is this. Currency moves are zero-sum at the aggregate level, but they're not zero-sum at the individual level. What does that mean? At the aggregate level, if the dollar falls against the euro, someone with euros gains and someone with dollars loses. That's zero-sum. But at the individual level, some people see this coming and adjust. They move some money into euros. They buy international stocks. They lock in fixed-rate debt. Some people don't. They leave everything in dollars. They stay fully invested in use-only assets. They rent instead of owning. The difference between those two groups, the people who adapt and the people who don't, that difference is going to be significant over the next few years. If you want to track whether this thesis is playing out, here are the indicators to watch. You don't need to obsess over them daily. You're not a day trader. But check them weekly, maybe Sunday evening when you're planning your week. Think of it like checking the weather forecast. First, watch the dollar index itself, specifically the 95 level. You can find this on any financial website. Just search dollar index or DXY. If DXY breaks below 95 and holds below it for more than 2 weeks, that's a structural break. That's when the positioning accelerates. Why 95? Because that's been a support level for the last year. It's like a floor. If the floor breaks, prices can fall much further, much faster. Right now, we're at 98.3. A move to 95 is about 3.5%. Not huge, but significant. If it breaks and stays below 95, that's your confirmation that the managed decline is underway. Second, watch Treasury auction results. The U.S. Treasury has a website where they publish this information, but you can also find summaries on financial news sites like Bloomberg or Reuters. Specifically, look at two things: the bid-to-cover ratio and the percentage of indirect bidders. The bid-to-cover ratio tells you how much demand there was versus how much supply. If the Treasury is selling $10 billion in bonds and they receive $20 billion in bids, that's a bid-to-cover ratio of 2 to 1. That's healthy. It means twice as many people wanted bonds as there were bonds available. If that ratio starts dropping to 1.5 to 1 or lower, it means demand is weakening. Indirect bidders are foreign central banks. They bid through intermediaries, which is why they're called indirect. If that percentage starts declining consistently, if it goes from 40% down to 35%, then down to 30%, that means the structural bid is weakening. That's the confirmation that foreign official buyers are stepping back. That's a huge red flag. Third, watch cross-currency basis swaps, particularly dollar-euro and dollar-yen. I know this sounds technical, but you can find this data on financial data providers like Bloomberg or even some free sites. What you're looking for is the spread. If the spread starts moving toward the dollar, needing to pay a premium instead of receiving one, it means there's stress in the dollar funding markets. That's a leading indicator. It tells you stress is building before it shows up in the spot price of the dollar. Think of it like this. Basis swaps are like the plumbing underneath your house. Everything might look fine on the surface, but if there's pressure building in the pipes, eventually something's going to break through upstairs. The basis swaps tell you about the pressure in the pipes. Fourth, watch gold. This is the easiest one to track. Gold is the anti-dollar. It's been money for thousands of years. When confidence in fiat currencies, government-issued currencies like the dollar, declines, gold rallies. We've already seen gold move above $2,600 per ounce in recent months. If it breaks $2,800 and holds above it, that's telling you something about broader currency concerns. Not just the dollar, but people questioning whether any paper currency is a reliable store of value. That's a big deal. You can check the gold price on any financial website. If you see it consistently making new highs, staying above $2,800, that's your signal that this isn't just about the dollar. It's about a broader loss of confidence in the entire fiat currency system. Fifth, watch policy responses. This is more qualitative, but it's important. If you start hearing coordinated statements from central banks about monitoring currency markets, that's a signal. When officials usually say nothing about day-to-day market moves, suddenly feel the need to comment that tells you the moves are getting large enough to matter to them. If you start hearing talk about intervention, where central banks actually buy or sell currencies to influence prices, or about swap lines being activated, that's a sign the move is getting large enough to require action. Swap lines are emergency arrangements. They're not used unless there's stress. If the Fed announces a swap line with the European Central Bank or the Bank of Japan, that's your signal that things are getting serious. When should you start paying real attention? When you see 2 or 3 of these indicators triggering at the same time. 1 indicator might be noise. 3 indicators is a pattern. That's when you know it's real. Zoom out for a moment. This isn't just about the dollar. This is about the end of a monetary regime that has been in place since Bretton Woods collapsed in 1971. Let me give you some history because it helps you understand why this moment matters. In 1944, at the end of World War II, representatives from 44 countries met in Bretton Woods, New Hampshire, and created a new global monetary system. They agreed that all currencies would be pegged to the US dollar, and the US dollar would be pegged to gold at $35 per ounce. The US promised that anyone holding dollars could exchange them for gold at that fixed price. This made the dollar as good as gold, which made it the global reserve currency. This system worked for about 25 years. But by the late 1960s, the US was running large deficits to fund the Vietnam War and domestic spending. Other countries started questioning whether the US really had enough gold to back all the dollars in circulation. In 1971, President Nixon closed the gold window. He said the US would no longer exchange dollars for gold. Bretton Woods collapsed. What replaced it? A system where the dollar was backed by nothing except faith in the US government. It became a fiat currency. Fiat means by decree. It has value because the government says it has value, not because it's backed by gold or silver. For 50 years, the system has worked. The world has operated under a system where the US dollar was the unquestioned reserve currency, where US Treasury bonds were the risk-free asset, the safest place to put your money, where the US could run deficits without consequence because the rest of the world wanted to hold our debt. That system worked because of 3 conditions. First, the US had unmatched economic dominance. In 1971, the US represented about 35% of global GDP. We were the factory of the world after Europe and Japan were rebuilding from World War II. Second, there was no alternative. The Soviet Union was behind the Iron Curtain. Europe was fragmented. Japan was just emerging. If you wanted to hold reserves in a stable, liquid currency, there was only one choice, the dollar. Third, the benefits of dollar stability outweighed the costs of dollar dependence. Countries were willing to accept the risk of holding dollars because the alternative, multiple reserve currencies, exchange rate instability, trade barriers, was worse. Those conditions are no longer true. The US share of global GDP has shrunk. We're now about 24% of global GDP. China is around 18%. The European Union as a bloc is around 17%. We're still the largest single economy, but we're no longer dominant the way we were in 1971. Alternatives exist. Not perfect alternatives, but alternatives nonetheless. The euro exists as a unified currency for a 350 million person economic bloc. The Chinese renminbi is gradually being used more in international trade. Digital currencies are emerging. Central bank digital currencies are being tested. And the costs of dollar dependence, the vulnerability to US sanctions, the exposure to US policy volatility, the risk that the US might freeze your assets if you displease Washington, those costs are now being weighed more heavily. When the US froze Russian central bank reserves after the invasion of Ukraine, every other country with dollar reserves took notice. If it can happen to Russia, it can happen to anyone. That creates an incentive to diversify away from dollar dependence. What we're watching is a slow-motion shift from a unipolar monetary system to a multipolar one. Unipolar means one center of power. Multipolar means multiple centers. The dollar won't disappear. The US isn't becoming a minor economy, but the dollar will share the stage with other currencies. Instead of 57% of global reserves being in dollars, maybe it goes to 45% over the next decade. Instead of 88% of all foreign exchange transactions involving the dollar, maybe it goes to 75%. And in that transition, the dollar's value has to adjust downward to reflect its diminished role. That's not a political statement, it's arithmetic. If global demand for dollars is declining and the supply of dollars is increasing, the US keeps running deficits and issuing more debt, then the price has to adjust. Supply and demand. This is the larger pattern. The dollar's decline in 2025 wasn't a blip. It wasn't a temporary correction. It was the beginning of something bigger. The positioning we're seeing now, the accumulation of short positions by sophisticated macro funds like Soros's, that's not speculation. That's recognition. Recognition that the structural forces are aligned in one direction. Recognition that the path of least resistance is down. Recognition that the question isn't whether the adjustment happens. The question is how fast. The question is not if the dollar moves lower from here. The math is too clear. The positioning is too one-sided. The structural bid is too weak. The question is how long the managed decline can remain managed. How long before the slow grind becomes a fast break? How long before the reflexive assumption that the dollar always rallies in a crisis gets tested one more time and fails decisively? George Soros understands this. He understood it in 1992 when he bet against the British pound. Let me remind you what happened then, because it's instructive. The British pound was in the European exchange rate mechanism, a system that required the UK to keep the pound within a certain range against the German mark. But the UK economy was weak, unemployment was high, and keeping the pound at that level required the Bank of England to keep interest rates high, which was killing the economy. Soros saw that this was unsustainable. He saw that the Bank of England couldn't defend the pound forever. So he built a massive short position. He borrowed billions of pounds and sold them for German marks. On September 16th, 1992, Black Wednesday, the Bank of England spent billions trying to support the pound. They raised interest rates from 10% to 12%, then to 15%. It didn't work. By the end of the day, the UK withdrew from the exchange rate mechanism and let the pound float. The pound crashed. Soros made over $1 billion in profit. The lesson from 1992 isn't that Soros is a genius who sees things nobody else sees. The lesson is that when a currency is being artificially supported at levels that don't match economic reality, eventually that support breaks. It doesn't matter how much political will there is. It doesn't matter how much money central banks spend defending it. The market is bigger than any central bank. When the fundamentals don't support the price has to adjust. That's where we are now with the dollar. The fundamentals don't support a strong dollar. The U.S. runs large fiscal deficits. The U.S. runs large current account deficits. Foreign demand for dollar assets is declining. The dollar's role in the global system is shrinking. These are the fundamentals. The price hasn't caught up to the fundamentals yet, but it will. Soros understands this. He understands it now. The trade isn't about predicting a specific date or a specific level. You can't say, on March 15th, the dollar will be at 93.2. That's not how this works. It's about recognizing when the system has reached a point where the only way forward is through adjustment. An adjustment in currency markets means devaluation. If you understand the mechanics, how foreign holders are positioned, how Treasury auctions work, how basis swaps reflect stress, how feedback loops accelerate moves. If you understand the flows, if you understand what happens when the assumptions that underpin a currency regime stop holding, then you understand why this trade is being put on. You understand why size is being accumulated quietly by the smartest macro funds in the world. You understand why this is not a gamble. This is inevitability. And in markets, inevitability is the most profitable trade there is. Not the flashy trade, not the headline-grabbing trade, the quiet trade that recognizes structural change before it becomes obvious, the trade that positions for an outcome that seems unlikely until suddenly it seems inevitable. That's what Soros is doing. That's what the smart money is doing. The dollar is going lower. Not because of a crisis, not because of a crash, but because the system that has supported it for 50 years is changing, because the conditions that made dollar dominance possible are eroding, because mathematics and market forces are more powerful than policy statements and wishful thinking. The only question is how long you have to prepare. Months? A year? 2 years? I don't know exactly. But the direction is clear, the path is clear, the outcome is clear. What you do with that information is up to you.